On board then Pratik Gupta, CEO and co-head at Kotak Institutional Equities, to talk a little bit more about the bull run, sustaining, as well as which themes one should keep on their radar. Good to have you on board. Thanks so much for taking time out and joining in. Let's just talk a little bit more about how you've divided the large caps versus the mid caps. Do you believe that the risk reward looks better when it comes to large caps, even though some of them have been slightly underperforming as compared to the broader markets?
Hi, good morning. Yes, agree with you. The large cap valuations have become far more attractive compared to the mid caps. Just to put some numbers in perspective, the Nifty year to date from January till now is up about 7%, whereas the small and mid cap indices are up anywhere between 28 to 30%. And obviously, individual stocks have done far better. So while there's a lot of excitement around small mid caps given their recent performance over the last 6 to 9 months or so, but one also has to keep in mind the valuations and what the stocks are already pricing in. So while we're quite positive on the long-term and medium-term outlook for the Indian economy, for the businesses in general, but one also has to anchor their investment portfolio to valuations and what's already priced in, and the risk of disappointments. And you still have a lot of geopolitical events, risks out there. You have potentially, right now the markets are celebrating what's going on with the US Fed, that the rates have peaked. One never knows. Inflation is still running quite high, and they may actually be forced to hike again. And in India, we have the election risk. One never knows which way that might go. So there are still risks out there, but the more important factor is valuations. We are seeing at Kotak, we cover about 250 odd stocks, and we're seeing a lot of the small and mid caps are trading well above their pre-COVID valuations as well, which is not necessarily the case in all large caps. But in general, large caps appear far more attractive to us versus small and mid caps.
What within large cap then, Pratik? Hi, this is Anisha joining in the conversation. Is it just the financials and the private banking names that have been underperforming and look a bit attractive?
Well, private banks is still definitely one of the areas that we still like. Again, as you rightly pointed out, partly because of their recent this year's underperformance, and the valuations are still quite attractive. We still believe we're in the midst of a very strong banking sector upcycle for the next 2-3 years, wherein loan growth will remain quite robust in double digits. You will see NIMs coming off very, very slightly. And the credit costs will still remain quite low. And you have upside from faster than expected loan growth as and when the capex cycle, private capex cycle picks up. So in that context, the private banks, especially those with a strong liability franchise, the deposit franchise, they look quite attractive to us, especially again, given their valuations and how these stocks have underperformed the market over the last 6 to 9 months. So that's private banks, but we also like a couple of the leading PSU banks, similar logic, attractive valuation, strong banking upcycle, low risk of credit costs going up very sharply. But other than the banks, we also like, for example, the insurance companies, especially the life insurance companies, the real estate sector. Let me just talk about the real estate sector briefly. This is one sector where companies have generally deleveraged quite aggressively over the last 2-3 years. Their net debt to equity has come off very sharply. The pre-sales, which we have been seeing, especially in the last few months, have been picking up. The cash flows are looking strong, and interest rates have also, in our view, at least domestic interest rates are close to their peak. If not, they may have peaked already. So the outlook for the real estate companies, the residential real estate companies, is quite strong. So that's the other sector that we like. And last but not the least is consumer staples. India had a sort of a K-shaped recovery, post-COVID, and now finally we're seeing, the bottom end of the K gradually picking up, and we think there's upside over there. But yes, private banks, insurance, real estate, consumer staples, these would be the sectors we would be focused on.
I think it's just interesting that you say consumer staples, because, what we've seen is down trading pretty much across the segment in lieu of, an upscale in inflation. What makes you bullish in consumer staples?
So that is correct, but that in our view is more sort of backward looking. We think the worst of the downturn for the consumer staple companies is behind us. We believe first you'll have the usual pre-election boost, typically government spending or political party spending. That's one. Second, the consumer is gradually recovering. We are seeing signs of the post-monsoon pickup in rural recovery. Third, raw material prices have come off. And fourth, our preference for consumer staples is that against of consumer discretionary, where we think demand there is still quite weak. And from a valuation perspective, we find consumer staple stocks still relatively better compared to, say, the discretionary names.
Given that, Pratik, the expectation is that we are seeing a strong capex boom, how do you believe investors should really play on that theme for the long haul?
So, yes, we are also in the same camp that you will see a long capex cycle, but capex has to be divided, in our view, in 3 different buckets. First is the government capex, which is central government capex. Then there is state government capex. Then there is PSU capex, and then there is private capex. And then there's also actually, I would call MNC capex, which is a smaller part of the overall capex plays. Now, as far as central government capex is concerned, I think despite all the excitement, one needs to keep in mind that, again, that is more of backward looking. It's, in our view, given the fiscal constraints, it is going to be difficult for the central government, whichever political party comes in next year after the elections, to sustain the growth in central government spending the way what we saw was happening in the last few years. Just to give you some numbers, the central fiscal deficit, which is budgeted at 5.9% this fiscal year, FY24, has to be brought down to 4.5% by FY26. So that's 130 odd basis points, which of a reduction in central fiscal deficit. So in that sort of a constraining environment, we don't see the scope for a dramatic increase in central government spending. Almost similar situation with most states. Most states are running large fiscal deficits. Again, over there, there's after the elections, there's going to be pressure on them as well to try and reduce their spending. So as far as government capex is concerned, we think the growth rate is likely to slow down. And again, a lot of the stocks are already pricing in that this sort of government capex will sort of carry on forever, which we think is unrealistic. As far as private capex is concerned, obviously we've seen some pickup and we are seeing green shoots all around and the order books are picking up, but the pace of the pickup is a bit slower than expected. So that's where, companies which are uniquely positioned or have strong balance sheets, have strong cost controls, they'll be better positioned. But again, we would not be carried away and recommend that you need to look at valuations also. You can't completely ignore valuations and just say, it's going to be fantastic next 3 years, no matter what happens. But even over there, you do have all kinds of external and domestic risks to keep in mind. Companies are being somewhat cautious. So it is going to continue picking up, but perhaps not at the pace at which the stocks are implying right now.
Say the best is, could be behind, at least for the near term, in spaces like, say, defense and railways, which did get pretty frothy about 2 months back.
Yeah, I would agree. I think you got to be a bit careful in those spaces. The stocks have had a very nice run up. They're extrapolating whatever's happened last few months, last 1 or 2 quarters, and that I think is a bit dangerous.
But this entire, premiumization theme, Pratik, how are you playing that? And even the new age tech companies are showing signs of reversal, whether it's a Zomato, decent numbers from Nykaa as well. Would you now look at these companies also positively?
Yes, we've been positive on some of these stocks. And frankly, the concern with, depending on which company, but one of the concerns in the past was capital allocation and the cash burn that was out there. And after the sharp correction in stock prices, I think late last year, early this year, etc., in many of these stocks, partly triggered by a wave of pre-IPO lockups expiring and share sales, you saw the stock prices coming off very sharply. But either way, whatever be the trigger, but basically we have seen these managements become far more disciplined, one, when it comes to costs, their operating costs, And second, when it comes to capital allocation, meaning getting into new adjacent businesses which may burn up capital. And in fact, the efficiency which they're squeezing out has actually been quite impressive. So we think this trend will continue, and also because of the sort of lack of excitement in the private funding market, their competition, it's not easy for them to get funding easily. So that implies an implicit advantage for the existing listed players who already raised capital, are sitting on large chunks of cash. They have the ability to sort of keep on spending. And at the same time, what the market is liking is the fact that these companies are turning profitable or staying profitable in some cases, and the profit margins, EBITDA margins, contribution margins are improving. So that's actually a positive. We think structurally over the next 3 to 5 years, this is a good theme. In a couple of cases, unfortunately, these stocks have gone up very sharply, so there could be a near-term pause. But by and large, we're quite constructive on most of the new age companies, the listed ones.
Sure. Pratik, just as a view here, what's this lively primary market telling you? I mean, literally there's an IPO opening just about on a daily basis and finding good subscription.
Yeah, so the IPOs, I think I would like to point out, Kotak is again involved in most of the IPOs in India, the leading IPOs in India. And what we find is the anchors typically tend to be the local investors, the domestic mutual funds, the domestic insurance companies. And these folks are still seeing very strong flows into either their small mid-cap funds or in general inflows into their equity funds. And the foreign investors tend to be, over the last few months at least, they tend to be followers rather than leaders in these IPOs as far as the institutional part is concerned. And then the retail and the HNI segment jumps in as well. What we are finding, though, I must say, in the last, month or so, there is some, what should I say, the investors have become a little bit more discerning. The valuation expectations of the promoters are being brought down a notch because investors are indeed getting a bit cautious in terms of what valuations they're willing to pay. These are unlisted companies. There's a risk. They don't have a track record. So investors have to go with sort of management commentary and guidance on what the business outlook is. And to that extent, we are seeing a little bit of a sort of some of the froth being taken out. But I would just like to point out once again that this is really being led by strong domestic flows, and that should continue. Although typically what we've seen in the past, ahead of national elections, there tends to be a bit of a slowdown in the IPO cycle. So one should expect a little bit of a slowdown next 6 months.
On that note, we let you go. Thank you so much for making time and speaking with ET Now. But time now to take a quick look at the markets as well.